Hi, in this video, I will be explaining about the hedging concepts and strategies. I will cover what hedging means, how it works in financial markets, and the four main strategies used by companies and investors. Let's start with the basic idea of hedging. What is hedging? So hedging is a risk management tool that helps reduce potential losses. It works by taking an opposite position so that if one side loses value, the hedge helps balance it out. You can think of it like insurance. You pay a small cost now to protect yourself from a big loss later. Hedging is used in many industries like finance, agriculture, energy, and international trade. So how does hedging work? Hedging is usually done through derivatives, which are the financial instruments whose value comes from an underlying asset such as stocks, commodities, currencies, or interest rates. Some of the most common tools used in hedging are futures, forwards, options, and swaps. Each of these instruments behaves differently and is chosen based on what type of risk the company wants to protect against. There are four popular hedging strategies: commodities, currency, interest rate, and equity hedging. Each strategy protects a different type of risk, and they are widely used in real-world business operations. First, we will talk about commodity hedging. Commodity hedging is used when companies rely on raw materials that have unstable prices, such as fuel, wheat, or metal. A good example is airlines, which hedge their jet fuel prices using futures contracts. By locking in the price earlier, they avoid sudden increases and can manage their operating costs more effectively. A good example for commodity hedging would be AirAsia hedges its jet fuel or oil prices. Because fuel prices can be extremely volatile, AirAsia locks in fuel prices through futures contracts to stabilize their operational costs and avoid sudden spikes in expenses. Second would be currency hedging. Currency hedging protects companies that deal with foreign currencies. Exchange rates can change suddenly, so importers and exporters often lock in the rate using forward contracts. For an example, a Malaysian business importing from Japan may hedge the yen to avoid paying more if the currency becomes stronger. A real-world example for currency hedging would be a Malaysian company that needs to exchange ringgit into US dollars may lock in the MYR to USD rate using a forward contract. This protects the company from having to pay more if the US dollar strengthens in the future. Third would be interest rate hedging. Interest rate hedging helps companies manage the risk of changing interest rates. If a company has a variable rate loan, they can use an interest rate swap to convert it into a fixed rate loan. This gives them stability and better control over their future loan repayments. For an example, if a company is worried that interest rates might increase in the future, they can enter into an interest rate swap. This allows them to change their variable rate loan into a fixed rate loan, giving them more certainty over their future financial obligations. Lastly is equity hedging. For investors, equity hedging protects stock portfolios during market downturns. A common method is buying a put option, which gives the right to sell shares at a fixed price. So even if the market crashes, the investor's losses are limited. For instance, an investor holding Tesla shares may be worried that the price might drop. To protect themselves, the investor buys a put option on Tesla. This put option allows them to sell the shares at a fixed price even if the actual market price falls, which helps limit their losses. To conclude, hedging is an important financial strategy used to reduce risk and protect against uncertainty. It works by taking opposite positions using instruments like futures, forwards, options, and swaps. The four main hedging strategies, commodity, currency, interest rate, and equity hedging, help companies and investors manage different types of risk. Overall, hedging provides stability, helps with planning, and prevents unexpected financial losses. Thank you for watching.